Okay, hello everybody. Welcome to Korean Atlanta Mentorship. Today is Saturday, and we are doing Saturday Debt Crusher Velocity Banking Training. And it's the almost the new year, and so if you're using your Saturday to learn about how to crush debt, congratulations to you because you are one of the few and the bold who will use their Saturday to learn how to crush debt. Okay, so I don't know if you ever read any of these articles. I see all of these all the time on the internet about how people are sinking in debt. And I don't know if this is you, or maybe you just don't make enough income, right? So if you don't make enough income, you probably don't have that much debt compared to someone who's making six or seven figures and living paycheck to paycheck. And to be honest, this channel is the reason why I've met so many people who are six figures and still living paycheck to paycheck, right? They see the videos and they're like, I got to reach out to this guy. And they're just, wanting me to help them, which I definitely hope that I'm able to do, right? So what we're going to do is we're just going to do velocity banking with our Excel spreadsheet, right? So velocity banking is a very easy in my opinion, debt payoff strategy using lines of credit. And if you've never heard of it and you just want a very basic explanation, go ahead and click the link down below to Velocity Banking 101. Okay, so there's two things that we need in order to do velocity banking. We need a budget, and I've done the budget, right? So we have our paycheck, we have our expenses, we have our leftover checking savings. Now, this person's six figures, right? And has about $1,000 a month left over in the checking savings, which is pretty good, right? Pretty good. I remember reading a Federal Reserve study that said if you have over $400, or most people could not meet a $400 emergency if they had to pull it out of their checking and savings. That's what I remember, right? But this person has some debt, right? We got credit card one, two, three, an auto loan, mortgage, other food, insurance, gas costing $1,500. And what we want to do is we want to eliminate debt, right? The more debt that we eliminate, the better our lives will be. Okay, so now we have our budget. So what's the next step? Step number two is we need a line of credit that we're going to use as an operating account. Now, if you look at this person has a mortgage. And what does that mean? That means we're a homeowner. We own a home. Isn't that exciting, right? But have you ever seen how much money a bank makes on a 6% mortgage? It's about 100, I think 112% interest over the life of a 30-year loan, assuming you never refinance. You actually pay it for 30 years, right? So that little $1,200 payment, the bank likes because they get 112% return, which I would love, right? And this is why I'm thinking, should I lend money? Should I not? I don't know. Okay, so now what we're going to do is we're going to rearrange our finances, velocity banking, so that we can easily pay off our debts. And the cool thing about owning a home is that if you have something called equity, you could use that equity almost similar to a credit card, which they call it a home equity line of credit, right? So let's just assume that we have a new $200,000 loan, but we bought real estate at a discount. So I don't know if you're aware of this, but you can buy real estate at a discount. It's not hard, but it's not easy. You gotta do a little bit of sleuth work and marketing and know how to reach out to the right people and negotiate. But most people just buy off the retail Zillow, MLS, whatever, and they get I don't know if you ever heard the statistic, but 93% of home buyers in the U.S. regret buying in 2023. And why is that? It's because they simply overpaid, right? So what we have to do is make sure we buy a home at a discount. And when we buy a home at a discount, we generate instant wealth with that equity. And the banks say, hey, we're willing to lend you that a line of credit, and you just secure it with your equity. And what's equity? All it is the debt, or I'm sorry, the home value minus your home debts, right? Home value minus your home debts. So let's say we have a $300,000 property and $200,000 loan. That's $100,000 equity position. So they usually lend up to 80% of that. But let's just assume that we got a $50,000 credit limit, right? $50,000 credit limit. Okay. Now what we're going to do is just rearrange our finances so that we can easily pay off this debt, right? And what we're going to do is just transfer some of these debts into the line of credit. Now, here's the thing. If we're going to move these credit cards into this line of credit, it's going to be awesome because we're going from a 30%, 20%, 27% interest rate to 10%. And just by doing that, we're going to win. But that's not our main focus. Our main focus is to increase our cash flow, right? And so if we have all these debts, right, how do we know which ones we're going to move into the credit line? And what's the basic strategy? Because I didn't really go over the basic strategy. The basic strategy is you take your entire paycheck into the line of credit, you take out your expenses, and then you rinse and repeat and see that cash flow remove your debt, right? It's an easy system. Like, I don't have to even think about it, right? The only reason that your debt shouldn't be going down is because you have way too many more expenses that overrides your cash flow. But right now we're in a pretty good position, so this is what we're going to do. And actually, let me just go over this, right? So if you want to know which debts to move to that line of credit, there's actually two types of criteria you can use. You can find loans or debts that all fit in as much as possible to these three categories: the highest payment, the lowest balance, and the highest interest. Or you can use what we call the cash flow index formula, which completely ignores the interest rate, right? So let's go ahead and just do the cash flow index formula. And we're going to do this. So let me go ahead and highlight this a little bit better. But all you have to do is just take the balance, 10,000, and divide it by the minimum payments, 325. And it's going to give you an arbitrary number. Divide it by 525. And then this one is 32,000 divided by 986.67. Whoopsie, I screwed up with that one. I'm going to go ahead and do this. 0. Okay. And then equals 22,000 divided by 425. And then 200,000 divided by 120. 1,200. Okay. So basically, this, you could kind of think of this as a ranking system, right? So the debts that you want to pay off are the lowest number. Are the debts whose cash flow index is the lowest, right? You pay this off, you get $400 of cash flow. That's what it's saying, right? But think about this. If you pay off a $200,000 mortgage, you only get $1,200 back in cash flow, which is why this number is so high, right? That's why the number is so high. The higher the number, it's kind of like worse in terms of like what they call cash flow efficiency, okay? But let's go ahead. So we're going to definitely pay this off, 15,000, and this 10,000. So that's going to be 25,000 here. Okay, so we're going to pay this 10 and 15, so this is going to be 0 and 0. And then what about credit card 3? Can we fit credit card 3 into our line of credit? Let me think about this. Okay, so that's $32,000 balance. And if I add this 32, we do not have enough for that, right? So that will be 57. So we got to make sure that we decrease this enough so that we do have enough availability in our line of credit. But let's for now, let's just do this, right? Let's go ahead and copy and paste, and then we're going to sum up all of these expenses, and you just take a look at this. Sum up B8 to B13, and take a look. Wait, actually, what am I doing? We're in the C column, not in the B column. C8 to C13, and then take a look at this. We increased that cash flow by $725, right? So to get the cash flow, it's C2 minus C3, and now we will jump from $1,163.33 to $1,888 without really doing nothing other than rearranging our finances, right? So we want to increase this number as much as possible, and just rinse and repeat, and you'll see what I mean by that, right? Okay, so now let's go ahead and do this. So month 1, right, all it is the balance minus the cash flow, right? Because the statement hasn't been generated yet. So what's our cash flow? So let's just do this. Equals H3 minus 1888.33. Oh, did I screw up? Oh, it's H2, my bad. All right. So now we've done that, and then what we do is we just got to calculate the first statement's interest. They call it the average daily balance, or that the way that they calculate is the average daily balance. So you can just do this. Average, it may or may not be correct, but we're just taking the midpoint, and then we're going to multiply it by the interest rate, which is 0.1, and then divide it by 12. And so we have to pay $200 of interest for that month. Okay? So now what we do is we just keep going until we have enough availability in our credit line to move. It won't be $32,000 balance because once we make a few payments, it's going to go down at least a little bit, right? But let's just go ahead and now copy. And actually, let's just do this. Let's calculate the second statement. So the second statement is going to be H3 plus I3 minus our cash flow, which is 1888.8. I can't type today. And then now we just copy and paste the formula, right? So now we can see that our interest is decreasing, okay? And what we have to do is just be at a position where we can put in 32,000. So if we put in 32,000 here, is that above the 50,000? Let's just check. No, it's not. Okay. So let's go ahead and so let's just go ahead and do that. So let me just do this. If we can put in the 32,000. Yeah, we can do it at this moment. So how long did this take us? 3, 4, 5. Now, if we're actually going to do it really accurately, it's not going to be 32,000. It's going to be like 31,000 or maybe 30,000 or something like that. But let's just do this and make it easy on ourselves. So guess what? When we move this 32,000 to here, guess what happens? Oh my goodness, this turns to 0. Look at that increase in cash flow. We just jumped in cash flow. Isn't that amazing? Oh my goodness. All right, so now the next month, okay, we just kind of do the same thing, but we got to make a few adjustments because our cash flow is 2875, right? Bam. Okay. And then we just keep going ahead and pay it off. Whoopsie. And we rinse and repeat. We put our entire paycheck in, we take our expenses out. Now, just as a side comment, you can actually still use one of your credit cards, because what's the advantage of using credit cards? The biggest advantage of using credit cards is that it doesn't charge interest the moment you pull out money. Unlike when you pull out money from a line of credit, you're accruing interest no matter what. So if you pay off the credit card statement in full, you pay it off in full, the last possible moment from your line of credit, and then you can kind of delay some of the interest accrued on the expenses, right? But let's just keep going. All right, so now we're gonna get to a negative number, and then we'll just kind of readjust. So give it 1 second. So now let's see how long it took to pay off all that debt. Okay, so that'll be J7 plus 1. So now I just gotta do copy and paste that formula. All right, so I'll say it takes about 2 years to pay off this debt. So all these credit cards take 2 years to pay off. That's $57,000 of debt. Okay, so let's just do this. Let's write our results. Okay, so that'll be 2 years. No, let's see, 57K, 2 years, right? So this applies to these 3 debts. I hope I'm calculating correctly. Yeah. So we took about 2 years to pay these 3 debts off, right? And then now we have to tackle on the auto loan and the mortgage, right? So by the time you're at the auto loan, it's been about 2 years, okay? And we'll figure out what the actual balance of that loan is. So what's the balance of that auto loan? So you just do 22,000. Again, bankrate.com, in my experience, has all the best loan calculators that you can use. And I think I put this at a 6% interest rate. Okay, and then we'll see that amortization schedule, right? So that let's do 1 as the main starting point of when that debt happens. And then so if we go to 2025, 2025, this will be the new balance. So as you can see, we've significantly chipped away that auto loan, right? And so if we go back here, right? So now our current balance at this stage is going to be 13,981. That's right. So 13,981. Now the question is that here's the thing: we can overpay this loan directly from our checking and savings, but we're not going to do that because that's not what velocity banking is. If we decide we're not going to do velocity banking, right? Or we could just move some of these debts to the credit line, or we can just do it in little chunks, because especially with the mortgage, we're going to do it in little chunks, right? Because we have a $50,000 line of credit that's at a higher interest rate. And when you are dealing with cash flow indexes that are above 100, and you're moving a lower interest line of credit to a higher interest line of credit, or lower interest debt to a higher interest line of credit, you're going to pay a lot more if you move the entire thing than if you do it in little chunks, okay? But let's go ahead and do this, right? So now what we're going to do is we're going to free up that $425 of cash flow and just move the entire thing there, right? Let's just move the entire thing there. So one of the things that you can do is just kind of pay, like you could do it in chunks if you want to do it, and you don't really care about getting that $425, but let's just move the whole thing. 13,981. So let's go ahead and add that here, plus 13,981, right? And now we have debt again. But guess what? Oh, this 425 went to zero, and now we have $3,300 in cash flow, right? So now we just gotta keep going, and instead of 2,875, it's 3,300 cash flow. Oh my goodness, that's so easy, right? And look, how many months does it take to pay it off? 1, 2, 3 months. 20. Oh my goodness, this is way too easy. This must be a scam, right? All right, so now we're at month 28, and so now it's time for us to go ahead and tackle the mortgage, right? And I have this cheat sheet calculator by Renatus, right? So Renatus Velocity Banking, and I am an independent contracted marketer with Renatus, meaning that I distribute and share and enroll people with their education. Okay, so that's what I do. And if you are interested in joining this group and you want to be part of this group and enrolling the education, guess what? You get this calculator cheat sheet for free. And one of the things that we can do is, instead of me just kind of doing this with my Excel spreadsheet, you can actually use that cheat sheet calculator just to kind of estimate the payoff of the loan. Now, actually, let's do this. 28 months, right? So we'll say 28 months. How much have we paid off? So what's 28? Let me see, 28 divided by 12, that's 2.3 years. So 2.3 years. And how much did we pay off in total? So that's an extra 22,000. So that'll be 79K. 79K. Woo! 79K in 2.3 years. That's insane. My mind is blown, right? So now what we're going to do is figure out, with the mortgage, how long it's going to take us to pay this off. And here's the thing: when you have a very high cash flow index, right, you don't need to move as much as possible to the line of credit, right? You could just move the amount that your paycheck is in, and then just rinse and repeat, right? So I'll show you what I mean by that. But basically, what you do is you move maybe $6,000, overpay the mortgage by $6,000, move into your line of credit, and then have your cash flow get the line of credit back to zero, and then you just rinse and repeat over and over again. Okay, so now let's figure out what the balance of the loan is at 2.3 years. So that's how many months? That's 28 payments into the mortgage. Now what we can do here is do what we've been doing. So 200,000, 30 years at 6%, right? So let's go ahead and take a look at that and then look at the schedule. And we'll say the first payment is January 2023. Much easier to figure out things when you make the first payment January. Okay, so now 28 months. So that's 2 years. So 1, 2. What's 2 point? So 28 is 24. So 4 months. All right. So 1, 2, 3, 4. And what's the balance? The balance is 194,259.84. Okay, so let's go ahead and copy and paste this here. So that's the current balance, right? And look at this. We've been paying the debt for this mortgage for like 2 years, and look how little it went down. It only went down about $6,000, not even $6,000, a little bit less than $6,000. That's gross, right? Anyways, let me go back here. So now this is okay, well, actually, this is the wrong one. So 1199. So I think that's the right 1199. So I'll just do 1199. All right. So that'll be $1,200. And what we're going to do is put in our information here. So let me just go back here of what are our expenses except for the mortgage. It's this $1,500 right here. Right? So that's our new, we just put that as our living expenses. So 1,500, okay? And then now we have to put our income in, which is 6,000, 6,000, okay? Now take a look at this. How long does it take us? 4.2 years, right? 4.2 years to pay it off. Now here's the thing. Let's say I put the entire line of credit in it, 50,000. Look how much more interest that we pay if we do 50,000, right? And actually, I screwed this up because our line of credit is 30,000. But what I'm trying to say is that if you have a higher interest line of credit and it's a very, very efficient loan, according to the Wealth Factory or cash flow index higher than 100, you don't want to, all you have to do is just put it into little chunks. And actually, let me make this more accurate. So I'll say it's 10% because we're using our HELOC, right? And we'll just do it into little chunks. So we'll do $6,000 chunks, exactly as our monthly income. Okay, so now look at this, 4.1 years, and the interest that we're going to pay is only 25 grand, right? 4.1 years to pay off $200,000. Insane. Okay, so now we're going to do this. So 279K, and then what we're going to do is add the 4.1. 4.1 plus 2.3, so that's be 6.4 years, right? Until we're debt free. And I'm going to put debt free, right? Debt free. Bam. Isn't that crazy? Right? People are paying like mortgages for 30 years and they pay like 200% interest on their loan, and they're afraid to pay off the mortgage quickly. Why? Because they lose their cash flow and liquidity. But here, I mean, just in 2 years, we paid up $57,000 of debt. And then here, 79,000, and then here, $279,000 in total. Mind blown, right? I need a catchphrase. I'm trying to figure out what's the best catchphrase for the channel, because I figured I think I copied the phrase "mind blown" from somewhere else, right? And boom, I know I copied from somewhere else, so that's not mine. I got to come up with my own phrase or saying whenever we pay off debt. But dang, well, let me actually just put a boom. I like boom, debt free boom. All right, okay, so this is Create Atlanta Mentorship. If you're interested in joining our group, go ahead and click the Google Form link below. We'll get on a one-on-one Zoom call to figure out what you're looking to accomplish and see if you're a good fit for the group. Other than that, have a great day, and we will speak next time.